So looking ahead, keeping on this thread of portfolio construction, what guiding posts can investors use to adjust their US portfolio weights?
Sure. I mean, the history of the last 10 years would tell you that maybe there isn't all that much need to change, right? If you look at the way that allocating to market caps played out, market cap as a weighting methodology was tough to beat. It has to do with certain underlying trends that we've seen in the markets, the winners becoming ever bigger, right? And this concentration trend is, of course, underlining the success of market cap weighting. You'd find few instances where alternative measures of allocation really outperformed a market cap weighted approach, but that doesn't mean that they're necessarily irrelevant, right? If you look at year-to-date performance, for example, I mean, what has outperformed a market cap weighted approach to regional investing, for example, would have been a GDP weighted approach. So GDP weighting global equities, for example, would have outperformed market cap weighting. Similarly, if you weigh by revenue or even if you weigh by risk, that's another alternative that is getting more and more debated, where you look almost at a risk parity portfolio style construction, just to manage those risks that are now much more prominent in the market cap weighting methodology. That idea of weighing by GDP, for example, is much more, of course, of an institutional investor's idea, a long-term orientated idea. It adds a fundamental kind of anchor to how you value portfolios. It does come with some caveats, and I think the last couple of years also did show some of the challenges that come from that. If you look at the US market, does it make sense to weigh now the US by the GDP of the US? I mean, it's a market where you've got a lot of global companies, they make their revenues globally, so effectively you would argue, if anything, you would need to use not GDP but GNP, so the national product rather than the domestic product. But anyway, it would lead you to much, much reduced US weights, right? GDP weighted, you're looking at 25%. Revenue weighted, you're looking at more like 50% of US weights. So it would be a steep departure from that 70% that many portfolios sit at now. So it's not really a building block that can be employed as such, and that's probably also explaining why it doesn't exist as an ETF. But still, we think in a lot of conversations it is featuring more and more as like useful extra guideposts, as you say. Like it can just be an idea, okay, like where would a portfolio sit that is, for example, GDP weighted? And all of a sudden, it adds much more relevance to emerging markets again, which for now tend to be quite underrepresented at less than 10% of market share in global equities. And it gives a few ideas for the tilts. Effectively, the implementation, though, is not following any kind of strict alternative weighting measure, but is probably a combination of those, and ultimately comes down to the tracking error budget that is available. That is still the overriding constraint. Many investors are willing to dedicate maybe a percentage point or two of tracking error to change the regional allocation, simply because they are aware of the regional risks. If we say dispersion in the regions is significant, that means your risk contribution is very significant from entering any kind of tilt. The forecast would suggest that, well, over the years to come, that might still be the same environment. So that's why also investors there are quite cautious when it comes to making those changes.
Of course, your team are one of the firms that offer things like regional building blocks and even ex-US investments, excluding the US altogether. How effective are investors finding tools like that for when they're looking to manage their US exposure?
It's a tool that basically introduces just more simplicity to the question of this regional allocation. I mean, just now we've discussed all the different theoretical constructs that exist to do this weighting exercise. Effectively, I mean, in the past, investors looked at the different regional building blocks. They had a US allocation, a European allocation. For Asia, you would typically break up Japan versus Asia ex-Japan. If you follow those broad categories, for which many ETFs exist, of course, you're fairly well covered. You're missing out on a few markets, though. I mean, Canada is, for example, then one of those elements that typically gets a bit forgotten in a simple slicing up the world like this exercise. And that's where World ex-US then comes in, as a one-size-fits-all building block almost, where you say that, well, okay, if 70% is the US and 30% is the rest, first of all, it's for sake of simplicity, quite fair to treat that 30% as one rather homogeneous bucket versus the US market. And it breaks down the implementation question simply then to kind of like a two-line problem. You have US, you've got ex-US for the portfolio construction, and that is getting more and more traction with investors. So if you look at the size right now, it's about 2.5 billion or so, I think, that UCITS investors allocate to strict ex-US strategies, just that building block as such. So it is getting more prominent versus your typical multi-regional breakdowns that investors are running. So yeah, it keeps the portfolio quite neat, keeps it simple. It also, and that's a little bit the side effect of that, of course, offers new routes to play the US market. That's I think the added benefit. So far, a lot of the questions that investors are discussing aren't really all that much about whether to allocate to the US or not, but it's still also a lot of conversations about how to allocate in the US. What index in the US should I pick right now? And after excluding the US, of course, it's then a question of like how you bring it back, and there are very different routes from kind of like looking at structural uplifts from a swap-based implementation to maybe more at a thematic kind of footprint. So it's quite the broad landscape that's offering as well then.
As you were saying there, of course, a lot of investors aren't looking to get rid of the US, let alone even underweight it. For those who are still looking to dial into the US, but are sort of mindful of things like concentration risk, aren't happy moving down into small caps, what are the alternative strategies that are available to them that sort of maybe help them manage some of those risks they're mindful of?
If you just look at the market flows and also the established categories, I guess the immediate answer would be equal weighting. That's still the big dominant trend. There's over 15 billion or so indexed versus equal weighted US indices out there. It's a big category, and investors are still using it. It's also, I mean, of course, positioning the portfolio for this mean reversion idea that at some point the average stock should perform again, because that's effectively what long-term capital market history would tell you. But it's introducing the risk, of course, that this alone might not be your perfect representation for the US market. If you look at the growth story in the US, it's still a tech-driven, AI-driven story. Just adding a value tilt towards the average stock might not really help. That value tilt and the focus on the average stock in the US market might still be more effective than looking at the small caps. That's a different debate, right? And the equal weight so far, I think, is favored by many because it just has a little more quality. But equal weight alone is probably not enough. That's what many are realizing. And so that's why they still look at kind of like either a thematic kind of addition to capture the broader opportunities of the US market. So thematic, big data, AI topics, add those in there as well. Or just traditional IT exposures. The NASDAQ, of course, still features in a lot of allocations as well. But it's more of a barbell, really, that we see, where it's demand for those tech-driven innovations that come from the US and are still dominated by the US, but are slowly changing. China, emerging markets, they play more of a role there. So that's getting reflected in those tech allocations. And then it's just the idea of capturing more breadth in the US market overall. And in combination, these solutions then can be quite meaningful. And it still, I mean, arguably keeps construction quite simple, because so far we've only then decided to slice up US, ex-US, and then you maybe break down the US into another 2 or 3 building blocks here. But you're looking at then a portfolio construction with 4 different indices. So still fairly easy to implement across the investor spectrum. And that's exactly what we see from like very institutional use cases all the way to retail.